Hello, and thank you for joining Homeownership OC for our free homebuyer educational workshop. We'll be getting started in just a minute. If you do have any questions, feel free to put them in the chat box or in the question box, and we will answer them as we go along. And let's go ahead and get started. So as I said, you're joining us today for Homeownership OC's Homebuyer Educational Workshop. My name's Connie Dertarosian. I'm the Executive Director of Homeownership OC and also a HUD-approved housing counseling counselor. I have over 20 years experience in the nonprofit world, working with various nonprofits, and also in the area of housing counseling, credit, and homeownership. And feel free to contact us at homeownershipoc.org. My contact information is on there as well. As I said, we are a HUD-approved housing counseling agency, and our mission is to promote and preserve the dream of homeownership, and we do that through outreach, education, counseling, and financing. We were started back in 2007, and we've helped many, many individuals achieve the dream of homeownership. And we've done over 400 events and workshops and educated over 38,000 individuals on home buying, credit, foreclosure prevention, avoiding real estate scams, rental, pretty much anything that has to do with housing. We do partner with other nonprofits, including the Fair Housing Foundation, on our rental and fair housing educational and counseling. And you can find us on social media. We're on Facebook, Instagram, Twitter, YouTube. Um, and our website has some great information at homeownershipoc.org. As I said, we do partner with the Fair Housing Foundation, which is our fair housing partner here. They're also a nonprofit, and their mission is dedicated to eliminating discrimination in housing and promoting housing access choices for everyone. They offer fair housing, landlord tenant counseling, rental counseling, of course, fair housing counseling as well. So if you have a fair housing question, you can reach out to us, or we can put you in contact with the Fair Housing Foundation. And they do service over 7,000 clients a year. So they're busy, busy folks, but a great partner to have. So today we're going to ask you to complete our online intake form if you haven't already done so. That's also located on our website at homeownershipoc.org, or you can scan the QR code. We're going to ask you for some demographic information, budget information. We're able to provide this information free to you because we get grants to underwrite and support our work. So that's why we ask you to collect the information in the intake. We won't be sharing it with anyone. We just keep it in our database. And this is also how we keep track of your homebuyer certificate that you'll be receiving at the end of the class. So if you have not already done so, please complete the intake form. You can scan the QR code or just go to homeownershipoc.org, click on complete intake. And once you're done with the intake and done with this class, then you will need to schedule a one-on-one counseling session with our housing counselor. And at the end of that, then we'll be able to issue your home buyer certificate. Okay, so this is our counseling agreement. They'll be sent a copy of all of this. And it just says that you agree to work with us and we won't share your information with anybody unless you give us authorization to do that. Our privacy form. So let's jump right in. So today's workshop is going to be split into two separate parts. We'll take a little bit of a break and we'll try to get this done in the next few hours here. So the first part, we're looking at assessing your readiness to buy a home, savings and spending, understanding credit, and we'll go over a little bit about the mortgage loan process and down payment programs as well. And we'll take a short little break, and then we'll start part two, shopping for a home, working with the realtor, managing your debt, protecting your investments, a little bit on fair housing, and then we'll go to the next steps. All right. So as I said, you will be obtaining your home buyer certificate at the end of the class. So we will be making sure that you are online and you're viewing this in full in order for you to get that home buyer certificate. So let's jump right into assessing your readiness to buy. So, of course, there are some advantages to homeownership, which is control over your environment. You have more stability. You know what your payments are going to be because you're going to get that fixed rate loan. There's great tax benefits. And of course, that one of the number one advantages is building equity and assets for you and your family. It's also an appreciating investment. So there's many benefits to homeownership. It's probably one of the largest purchases you're going to make over the years, and it is really the number one way for you to build wealth for you and your family. Some disadvantages are, of course, there are no guarantees. You will have some decreased mobility in that you would have to sell the home if you're going to move. Maintenance repairs will be your responsibility, and there are some additional monthly costs such as taxes and insurance, and it is a long-term investment. But as I said, I think for the most part, the advantages outweigh the disadvantages if you are in a position where you're ready to purchase. So also in renting versus buying, of course, renters are usually just responsible for their utilities. As a homeowner, you're going to be responsible for all your utilities, water, trash, property taxes, homeowners insurance, repairs and maintenance, and if there are any HOA dues or Mello-Roos, you'll be responsible for that as well. And we'll go over some of those costs. So let's create a map for your homeownership journey. Um, we have to first, when you first meet with the counselors, they're going to look at your affordability, which depends on several important factors, which include your income, your annual gross income, your credit history and score, current mortgage rates, down payment, the type of home you're going to purchase, as well as your current lifestyle and future plans, and then fees and closing costs. So when the counselor asks you for some documentation, we want to look at your income. We want to look at your credit score. We want to get your credit score as high as possible so you can be offered the best rates and loan programs. And then, of course, we're going to need some money for down payment and closing costs as well. So we're going to go over all of those costs that affect your ability to be able to afford a home. The steps in the home buying process. First, you're going to prepare yourself for homeownership. So you're doing that today. Then you'll determine how much you can afford. You'll apply for a mortgage, get your loan pre-approved, decide on the home that you'd like to purchase. Then you'll go shopping for a home. You'll make an offer or a counter offer, get a home inspection, and then complete the tasks that are necessary during escrow to close on that home. And then you'll close the loan. So it's really those 10 steps, and we're going to go over them in detail throughout the workshop. Again, if you have questions, feel free to put them in the chat, and I'll be happy to answer those as we go along or at the end of the workshop. So let's see, one question that we have is what is considered a first-time buyer? So if you have not been on title or on a loan for the past 3 years, you would be considered a first-time buyer. So let's say back in 2002, you were on title on a home, but you're trying to purchase now, you would be considered a first-time buyer. So some of the support that we offer for home buyers, of course, is the one-on-one coaching and counseling, post-purchase counseling. Today, you're going to get your HUD home buyer certificate. And of course, we offer the one-on-one counseling if you need to improve your credit, work on some things, or you have rental questions. We're always here to be a resource for you. So let's go over some savings and spendings. So let's plan how we spend our money, track our income and expenses, and how many folks here utilize some kind of budget or spending plan and track their income and expenses. Looks like a few of you folks do. And if you have any tools that you use that you want to recommend, feel free to let me know. Um, so you want to track your income and expenses every month and review and make an assessment, decide what's necessary and if there are areas that you may be able to trim. Of course, we want to boost that savings, set up a pattern to, save automatically. What I like is if you get paid every 2 weeks, then you go ahead and put a certain amount of money automatically into a savings account so you don't even see that money and it's automatically being saved and it's in a separate account. That's a great way to boost your savings and save for your homeownership journey. And you may also need some money for down payment or closing costs. So that's a great way to save that money. Know your triggers for overspending and address them. What are the underlying causes of those? If you go out shopping when you're stressed out, maybe there's something else you can do, like go for a walk, go for a hike, um, or go see a movie or something like that instead of overspending. All right, why is it important to have a savings and spending plan? What kind of connotations come up when we talk about a savings plan? Is it positive or negative? And what do you guys think are some of the benefits of tracking your spending? So a lot of people don't like the word budget, so I like to call it a spending plan, and it just really figures out how much money is coming in and how much money is going out. And of course, if we're in the negative, we need to figure out some ways to trim down some of those expenses or increase our income so that we can make it sustainable. So some of the benefits of tracking your spending is, of course, it'll help you keep on track. Let's see, some of the other recommendations are it will help you save money, which is a great one as well. So there's lots of benefits to tracking your spending, and there's lots of tools online that are available to help you with that. So it's important when you're buying a home to make sure that you have a savings and a spending plan because it can help you estimate what you're going to afford to pay in a mortgage, identify maybe where would be able to cut some expenses, and it will help you develop a stronger loan application. You can also prepare for any additional costs, and it will provide some motivation. So I know a lot of people have a lot of negative feelings and think like it's not possible for me to buy, but I can tell you that we have many successful clients who have gone through our program who were able to purchase, who were thinking just like you that they probably weren't able to purchase. But if you follow the guidelines that we help provide to you, create a savings plan, stay on track with your budget, and maybe utilize some of the down payment programs that we're going to be talking about today, there's definitely an opportunity for you to purchase. So there's different ways of tracking your savings and spending. You can write it down in a notebook. You could keep track on your calendar when you get paid. And as I said, set up those online automatic savings. There's some really great tools that some of the banks offer to help you create your budget. Mint.com is one that I've used previously that connects with your bank account and tracks your spending and helps you create a budget. So it will let you know if you've budgeted $300 for groceries and you go over to $350, it'll say you're $50 over, at the end of the month. So there's lots of great ways for you to track your spending, and I encourage you to do that on a monthly basis, at least for a 30-day period, just to see how your money is coming in, how you're using it, and how you're spending it. So we're going to figure out what your gross monthly income is and figure out what your monthly expenses are. So as I mentioned, in our intake, we ask you to complete a budget, just a simple budget to kind of see what kind of money is coming in and what you're spending your money on. So we're going to go ahead and do that right now. We're going to do an individual exercise. So if you have your budget in front of you, um, If not, you can just take out a piece of paper and we can go over it, over the different categories and try to figure out what you're spending every month. All right, so we're first going to put down how much money our household is bringing in. So if it's a husband and wife, we want both incomes on there. If your son or daughter contributes some money, we want the total house income, right? So we're going to write that down and calculate what the total income is for the household. And then we're going to write down our monthly expenses for telephone, utilities, water, trash, food, cable. If you don't know the exact amount, just estimate. I think you can kind of figure out what it is that you're paying each month. And like I said, if you want to sign up for one of those online budget tools, there's lots of great ones out there, lots of great apps on your phone that can help you track your budget. So go ahead and let's take a minute or two here to write down those expenses. We've got car payments, credit cards. You can just put the minimum that you pay monthly. Student loans, things like that, whatever your monthly payment is, daycare, um, gas, car insurance. If your car insurance is paid quarterly, you would just um, calculate what it is on a monthly basis. And like I said, if you don't know the exact number, at least come close and let's try to get a good idea of what your monthly expenses are. So we're going to jot those all down, and we have all of our income. We're going to tally that up and find out what our total income is. Then we're going to look at all of our expenses. We're going to tally up those. If you're paying rent, don't forget to include your housing cost in there as well. And then let's see where we are in regards to our monthly expenses as it relates to our income. So let's say, for instance, in this scenario, our income is $4,500 a month, but our expenses are $4,700 a month. That would be we're in the negative, right? So we want to make sure that we're looking at our expenses and figuring out if there's ways that we would be able to reduce some of those expenses to make it more sustainable. So we're going to look at some items like fixed items would be something such as your rent, which is due on the 1st, and it's always the same amount every month. Something flexible might be your going out, out to eat, or your grocery bill might fluctuate. And then there's periodic, which might be your car insurance. Maybe you pay it quarterly instead of monthly. So let's look at those expenses and take a deep dive of them. So as I had mentioned, we're going to determine from our spending plan if you have any extra monthly income. We're going to take our total monthly income, subtract our monthly expenses, and hopefully we're at a positive at the end of the month. So if we are in the positive, that would be extra income that we could go ahead and put into a savings plan. And we could start with having an emergency savings plan. And we like to have at least 3 months, but an even better idea is to have up to 6 months of your monthly expenses in a savings account, just in case an emergency may happen, so that we're able to be sustainable if you happen to get in an accident or something happened, and you had to use your savings to cover those expenses. Also, when you're purchasing a home, they're going to want to see that you have some money in the bank and you have some reserves, and usually it's about 3 months of the mortgage payments. All right, so as I said, there's lots of great tools out there that can help you with tracking your spending. I would track it for 30 days. 30 to 3 months is really great if you can do it that for that long, but 30 days is also really important. Um, So if you're going over, let's look at, where are we going over? Maybe it's groceries. Maybe we need to, maybe it's eating out every, couple of days here, or going to Starbucks or something like that. So are there areas where we can cut or where we can reduce some of those expenses, maybe eating at home a little bit more often, to help us reach our homeownership goals? And make sure that all members of the household are willing to follow the plan, get them actively involved in it, and let them know, hey, this is our plan. We'd like to save this amount of money to get us into homeownership. And so, we need to keep on track for our budget. So, some tips for saving for homeownership. Of course, boost your savings. Pay yourself first. As I said, set up one of those automatic payment programs where you're automatically taking your paycheck, some amount, let's say 50, $100 from your paycheck, and automatically putting in a savings account that you've decided you're not going to touch. Pay yourself first. If you're short on your goals, you may want to look for additional areas where you can increase your income, maybe gig work or getting a second job. Or perhaps you might want to use your tax return to boost your savings. All of these things are great ways to help you set a goal and plan for your homeownership goals. Let's talk about some money management tips. Of course, pay your bills on time. That will help you to improve your credit score. You want to keep your credit score high, or if you need a little help in that area, we can help you with that. We want you to improve it. Get your credit score as high as possible so that you can qualify for the best programs with the best rates. And we're going to show you how it eventually helps you to save money in the end. Control your day-to-day spending and create a spending plan and stick to it. All right, let's go into credit. So credit is really an x-ray of our financial health and kind of says how we've treated credit in the past is going to be on our credit report. So why is good credit important when buying a home? Lenders, of course, are going to be more likely to give you a loan if you've handled past borrowing responsibly. Higher risk loan from lenders' perspective will mean higher interest rates. So that's why I say we want to get your credit score as high as possible. And in the end, it will help you save money on loan interest rates with a higher FICO score. So here's an example of just, let's say we've got a 30-year mortgage on a $250,000 home. All right. So in this scenario, if we look at the higher FICO score, 4.096, the monthly payment would be 1,207. Total interest paid is 184,000. And of course, the higher FICO score equals lower payments and more savings per month versus, let's say you have a 5.68 FICO interest rate with a FICO score of 620, your payment might be a little bit higher at 1,448. And of course, you would be paying more in total interest. So higher FICO score, lower the interest rate, lower the monthly payment, and the less you'll be paying overall. So let's take a little examination of our credit reports. How many of you have looked at your credit in the last 6 months? Send me a message in the chat. Let me know. It's a good idea for you to check your credit report and do that on at least every couple of months. There are 3 national companies that supply the credit reports: Experian, TransUnion, Equifax. And it's basically a summary of your credit history. So you can obtain a free credit report through annualcreditreport.com. It used to be that you could do this once a year, but actually after COVID now, you can do it once a week. So it's the annualcreditreport.com website is sponsored by the three credit bureaus. And you can go on there and check it out and make sure that all of the information that's on your credit report is actually accurate. If there are mistakes, you can go ahead and dispute it through that annualcreditreport.com. It doesn't provide the credit score, but you can purchase your credit score through MyFICO, My Bank Rate. Credit Karma is another website that allows you to get your FICO score for free. There's a couple other ones like Credit Sesame. Sometimes your credit card or your bank will also give you your credit score as well. So there are a couple different ways of getting a credit report. So there is what is called a soft pull or soft inquiry, which does not affect your score. um, Consumer credit report. So when you're pulling your credit, or if we pull your credit as a housing counseling agency, it's a soft inquiry. So it does not affect your score at all. A hard pull is a hard inquiry, does affect your score, and it will be an in-file credit report. So when you're applying for a loan, an apartment, a car loan, that would be a hard pull, and it will affect your score. So what makes up a FICO score? It's based on five main categories in your credit report. The higher scores are better. Most consumers are between 300 and 850, and a higher score means you're likely to pay a lower percentage interest rate on a loan. So the five categories are payment history is 35%, amounts owed would be 30%, length of credit is 15%, and new credit and types of credit used are both 10%. So as you can see, the two biggest areas are payment history and amounts owed. So pay your bills on time. If you're not current, get current, and that will definitely help boost your score. And then amounts owed, let's make sure we're utilizing that as well. Payment history, 35% of the score, so avoid closing counts with a positive payment history. Keep making your payments on time, even if it's the minimum payment. What we recommend is use the credit card and pay it off at the end of the month. We shouldn't be utilizing credit if we don't have the money to purchase things. We shouldn't be using the credit card. Sometimes if an emergency comes up or you may need to utilize your credit card for that, that's fine. We want you to pay a little bit more than the minimum payment to be able to pay that debt off. Amounts owed is 30%. So use 30% or less of your available credit limit on credit cards and other revolving debt. So let's say, for instance, you have $1,000 credit limit, use $300 or less to keep that amount owed under the 30%. Or better yet than keeping that 30% is to pay off the debt in full and not pay any interest payments on that. So use it, pay it off, use it, pay it off. That shows that you're using your credit responsibly. New credit is 10%. So if you're going to be shopping for something, a car or furniture, do it within a 14 to 30-day window. New lines of credit, purchasing furniture, co-signing could negatively affect your score. Your credit report should also reflect current and accurate information, and it could affect your debt to income ratio. So make sure that all of the information that's on there is accurate. And if you're already working with a lender, always get your lender's approval before making any changes to your credit profile. Don't go out and purchase furniture or co-sign a loan, buy a new car when you're in the process of purchasing a home. If you do need to do that I would talk to your lender about it and make sure that it's not going to affect your score because they pre-qualified you on the information that's on there. All right. So let's talk about how can we boost our credit? We want to get our credit score as high as possible. Number one, pay your bills on time. If you've missed payments, get current, stay current. Be aware that paying off a collection account will not remove it from your credit report. If you're having trouble making ends meet, contact your creditors, try to work out a payment plan with them, or call us. We can help you with advising you on what you can do to improve your credit and work things out with your creditors. Amount owed tips, keep your balances low on the credit cards and other revolving credit, pay off debt rather than moving it around. Don't close unused credit cards as a short-term strategy to raise your score, and don't open new credit cards that you don't need just to increase your available credit limit. For new credit, do your rate shopping within that 14, 30-day period. Know that you can reestablish your credit if you've had problems in the past. And note that it's okay to request and check your own credit report. And we really do encourage you to look at your credit report, know what's on there, dispute things that shouldn't be on there, or let's say they've put you down as late. You can certainly dispute that and provide them documentation. And annualcreditreport.com makes it super easy to do that. All right. Let's see. Do I have any questions? Um, let's see. I have one question in regards back to credit. So, if I have a collection account and they're harassing me to make my payments. Um, do I need to contact them? Do I need to speak with them? So if someone's calling you and your creditors are harassing you, they cannot say that they're going to put you in jail, they're going to call the police, or they're going to tell your workplace that you owe them money. A lot of times they may do that. You can report them to the Federal Trade Commission, and you can also tell them that I don't want you calling me anymore. I just want information sent to me via mail. And they do have to abide by that. And if you do need help with, questions about collection accounts, you can go ahead and dispute those things and work with those creditors to pay them down. And usually they will um, let you pay less than the amounts owed when you're negotiating. All right, so we're going to do a little activity here, and we've got three different people, and I want you to listen to their scenarios and tell me, who do you think has the higher credit score and why? So we have Susan, Jonathan, and Maria. Okay, so Susan has an annual income of $31,750. She has a car loan for $12,760. She has one credit card that's paid off. A second credit card has a limit of $7,500, and she has a balance of $4,000 on it. She's never missed a payment on her credit card. Okay, so that's Susan. Then we have Jonathan. His annual income, $52,000. He has no car loan, no credit cards. He pays everything with a debit card or cash. And then we have Maria. Her annual income, $40,000. She has paid cash for her car, so she doesn't have a car loan. She has one credit card with a balance of $12,000 and a limit of $12,500. And she did miss two payments in the last year because she was traveling. So, given those three individuals, who would you say has the highest credit score? Would it be Susan, Jonathan, or Maria? Go ahead and send me a message in the chat or the question box and let me know. All right, we've got some who say Susan. A couple people have said Jonathan. And one person said Maria. All right, so the winner, the person with the highest credit score, is Susan. So Susan has a car loan and she hasn't missed a payment on it. She also has one credit card that has a limit of $7,500. And she has a $4,000 balance, but she's made all her payments on time. Um, So given these three scenarios, she would have the highest credit rating. Now, you might think Jonathan, because he has no debt, he has no credit cards, he pays everything with his debit card or cash, that he would have the highest rating. But actually, if you have no credit cards, no credit rating, it could be seen as you have no credit history, which can be seen as bad. So usually when you're applying for a loan, they're going to want to see at least three trade lines. So we would suggest that Jonathan go out and get a couple of credit cards, at least three, and start using them and paying them off, using them and paying them off. You can use it for your groceries and etc. and pay them off at the end of the month to show that he can utilize his credit wisely. Now, Maria, she did pay cash for her car, but she has one credit card with a balance of $12,000, and she's almost maxed out on that credit card. And she did miss two car payments, so of course her credit score is definitely going to be lower. All right, so that was very good. Good job on those who picked Susan. All right, so bankruptcy will affect your credit. Chapter 11 and 7, up to 10 years. A completed Chapter 13 bankruptcy, up to 7 years. It will affect your ability to qualify for a mortgage. There may be a minimum waiting period for FHA and other loan programs. So it's a good idea to talk to a credit counselor, talk to a housing counselor if you are considering bankruptcy to see what the implications are, because a lot of times you may be able to negotiate down the debt yourself without filing bankruptcy. Sometimes bankruptcy is necessary, but you will need to go through counseling, bankruptcy counseling, to find out if that's a possibility, but know that it may have some implications on you purchasing in the future. Not to say you can't, but if you have had dings in the past, you can certainly overcome it, but it may take some time. So what are some tips to improve your credit? Your credit score is based on information in your credit file and takes into consideration all the positive and negative information. It has no memory of your last score. So even if you've had a long, ugly history, your score will be weighed in favor of your last performance. So you can turn over a new leaf and start rebuilding your credit history. It does take a little bit of time. You're given points for positives and points are taken away for negatives. So it's important to reestablish positive credit to offset the negatives. So if you've had a late payment in the past, start making your payments on time. The further you get away from the negative thing, the more your score is going to improve. And the more you're replacing the negative thing with the positive thing, which is paying your bills on time, it will impact your score. So as you begin to utilize credit responsibly, you can improve a negative score. It does take time. As I said, you can also make sure that your balances are staying below the 30%, or better yet, getting paid off. What I do is I use my credit card and I pay it off at the end of the month. So let's have some hard truths about credit repair. No one can guarantee to remove accurate information from your credit report. There's no such thing as removing a foreclosure, bankruptcy, short sale, any of this stuff. It takes time to rebuild your credit. No one can legally create a new identity for you, and legitimate companies will provide a service before requesting payment, and the credit laws regulate credit repair. I personally think it's a waste of money, and majority of those companies are scammers. I don't know if you guys heard about that Lexington law that was like, oh, we're a great law firm and we can help get rid of your collections. Well, they got sued and there was a big settlement, and people paid, a lot of our clients paid thousands and thousands of dollars to these people, and they did not help them improve their score. And the CFPB went after them and made them pay back some of the money. But you know, a lot of the clients, what we say is you should have take that money that you're going to use for credit repair and use it to pay down your debt, or get a secured credit card from your local financial institution so you can start rebuilding your credit. So collections, you can negotiate with them yourself on paying them down. Let's say it was $1,000 debt, you could probably get them down to, $600. You can start with like 25% and work up from there. Okay. And it's best to try to negotiate to pay them off all at once if you have some money. If not, you can make payments on it to pay them down. But they're usually willing. They've probably paid pennies on the dollar for that debt, so they are usually are willing to negotiate with you. And your housing counselor can certainly help advise you on that. So again, you can get your free credit report, annualcreditreport.com. You can send your own dispute letters. You can dispute it on annualcreditreport.com. There's some good resources on credit.org if you'd like to check those out with letters and things like that. Definitely know your rights. The Equal Credit Opportunity Act and Fair Housing Act gives you a right to have a mortgage application reviewed without consideration of race, religion, age, national origin, sexual or marital status. The Fair Credit Reporting Act gives you the right to a free credit report once a year. And you can also dispute settlements for errors. If you get denied credit, they do have to send you a reason why. And you can also view your credit report in regards to that. The Fair Debt Collection Practices Act guarantees users' rights when dealing with debt collectors. All right, so we're moving into financing a home. We're going to do this section and then we'll take a quick little break and come into the home stretch. So let's talk about mortgages and how those work. So what is a mortgage loan? Well, here in California, we call it a deed of trust. And it's basically a secured loan agreement between a lender and a buyer in which the property is collateral for the loan. You'll usually work with a mortgage broker or loan officer to apply for the home loan. So a mortgage broker is an intermediary between the lender and the customer, and they shop different loans from different financial institutions and different loan products. Whereas a loan officer usually represents a lender or financial institution, may work for a specific bank like Bank of America, Wells Fargo, Citi, Chase. They have loan officers. Mortgage broker is usually independent and can offer different types of loans and programs. So where do we get a mortgage loan? So there's a couple people who originate those. There's, of course, the traditional banks. One advantage of borrowing from a bank is being able to keep all your financial activity in the same place. And sometimes the banks will give you an incentive if you're have your bank account with them and then you get your mortgage with them. They may give you, extra money and down payment assistance. So it's always a good idea to check out wherever you bank to see what kind of mortgage programs they have. There's also mortgage companies or mortgage bankers that will make loans that are secured by mortgages on homes. One advantage of a mortgage company is they specialize in mortgage loans and they may have various different programs. There's credit unions, of course, which is a private run by and for its members. Sometimes they have, special programs for their members, so you can check those out as well. And then, of course, nonprofit groups, they may have some mortgage loan products. They may get money from the government or grants to help with, usually it's for first-time buyers. And usually their terms are a little bit more favorable to the first-time buyer because our programs are, usually geared for the first-time buyer, and they know nonprofit organizations are working with the community. And then we have government agencies, which are state or local housing finance agencies that provide financing for special uses and especially for first-time buyers. So CalHFA is one that we have here in California. And then most of the cities and counties do have down payment assistance grants that you can look for. the county. We'll go over some of them. So I would look in the specific cities that you're looking for to see if they have different down payment programs. We're going to go over a few of them a little bit later in the presentation. So let's talk about your mortgage payment. It's going to include principal, interest, taxes, and insurance. Principal is the part of the mortgage payment that's applied to the original amount borrowed. Interest is the amount that the lender charges for lending you the money. Taxes is the part of the mortgage payment used to pay property taxes, and then insurance is, of course, used to pay your homeowners and sometimes mortgage insurance. So the PITI, when they say the pity, that is your full mortgage amount, right? So let's say you have a $250,000 home. You put 10% down, that'd be $25,000 for a 30-year term. Property taxes, usually around 1.5% property tax on the purchase price. And homeowners insurance in California could range from $800 to a couple $1,000. It just depends. They definitely have been going up, the insurance issues. So you definitely want to shop around for those. So what are the factors that may affect your mortgage payment? The down payment. So the more money you put down, the less you would need to borrow. Repayment terms of the loan, is it 30 years, 20 years, 15 years? The loan interest rate, home, and does your location include HOA fees or Mello-Roos? Mello-Roos are special taxes in areas, so you want to know and talk to your realtor if that area has a HOA fee and if it has Mello-Roos, because those are going to add to your mortgage payment. All right, let's talk about qualifying for a loan and affordability. When looking at affordability, you'll often be pre-approved for a loan when your housing payments and debt payments are equal to or less than 43% your gross income. So when we're talking about debt to income ratios, this is what we're talking about. When talking about your housing payments, we're going to be looking at your mortgage, property taxes, insurance, HOA dues, like what that total amount is. When we're talking about your debts, we're going to look at your loans, car loans, credit cards, child support. What are your revolving debts? And then we're going to also look at your savings, investments. And we also want to look at your household expenses. What are your living expenses for food, clothing, utilities, etc.? All right, so we want to make sure that when we're looking at all of your debts, that it's less than 43% of your gross income. And we'll show you a little calculator in the next slide or so. So of course, the less debt you have, the more purchasing power you have. So in the example on the left, with 5% of your income used for paying off debt and 38% available for a house payment, this individual is able to qualify for a higher mortgage loan. All right, versus the example on the right, they're using 50% of their income is allocated towards the debt, which only leaves 28% for their housing. So in that case, they have much less income available for their home and a lower purchasing power. So a lot of times when you're working with the counselor, they're going to ask you, what are your debts? What are you paying? And is there a way for you to reduce them? For sure, the credit card debt, we want to get rid of that. Maybe you're just 3 months away from paying off your car. We want to wait until you pay off that car. You have more money available for your housing payment. So how do we figure out your housing or front end ratio? That's the maximum percentage of a borrower's income that can be used to make a monthly mortgage payment. So let's just say we make $6,000 a month and our monthly housing cost is $2,000. That would mean that 30% is available for our housing front end ratio. So a lot of different loans have different debt to income ratios that are allowed. And when you meet with your lender, they're going to go over this, as well as your housing counselor, to make sure that you have enough funds available. We want to see your mortgage payment around 1/3 of what is owed, or of your income, if that's possible. So the back end ratio, or debt to income ratio, is the maximum monthly amount plus the amount the borrower can spend on a house payment plus their debts. Okay, so going with that same scenario, your mortgage payment is, let's say, $2,000, car payment 300, other loans and credit is 200, for a total of $2,500. So we're going to take that $2,500, divide it by our monthly income, which is $6,000, and we get a 41% debt to income back end ratio. So although each situation varies, a front end ratio higher than 38% or a back end ratio that's higher than 43% signals you may need to lower your debt or control the use of credit before attempting to purchase a home. And that's some of the things that the housing counselor is going to go over with you, as well as your lender, when you're qualifying for a mortgage. So as I said, we want you to pay down those debts and have as little as possible, have the highest credit score, so that we can get you the best possible rate that's available. So how do we calculate your affordable monthly payments? So we'd multiply your gross income by 0.43. That's a standard back-end ratio. And then subtract monthly debts from that total. The amount that we have left is the amount you could afford to pay each month on a mortgage. So if we take that scenario, we have $6,000 monthly income, multiply it by 4.43. Then subtract our monthly debt payments, which were $580. We have $2,000 available for an affordable monthly payment. So I don't want you to get too much into the weeds on the debt to income ratio, but I want you to know how they're going to calculate these numbers so that you know. The big picture here is that the less debt you have, the more money you have available for your housing payment, the better off you are. There's also what's called the loan to value ratio, which is the ratio of the loan balance you owe to the appraised value of the property. During the loan approval period, it will gauge the risk. A higher LTV, the lower the risk, and typical lower interest rate. The lower LTV, the higher the risk, and typically higher interest rate. So an LTV of less than 80% is ideal. And like I said, I don't want to confuse you all with this LTV, but I want you to know exactly what it is. All right, so we're going to go ahead and take just let's say a 10-minute break here. So go ahead, stand up, stretch your legs, and we'll come back in exactly 10 minutes and get done with the second portion of our workshop. Again, if you have any questions, feel free to put them to me in the chat box or the question box. I'll be happy to answer those for you. Okay, we're back and back for more fun. All right. So again, if you have any questions, feel free to put them in the chat box and the question box, and I'll be happy to answer those questions for you. Don't forget to complete your intake form. If you haven't done so already, go to homeownershipoc.org and click on that complete intake form. You'll have to put in your email, verify it, and then go in and enter all of the information. Make sure you include your budget, answer all of the questions, and then once we receive it, we will go ahead and schedule your one-on-one session. You'll need to complete that as well, and then you'll be able to get your certificate. All right, so you guys have been doing great. You've had some great questions along the way. So let's jump back in and continue on about mortgage loans and down payment assistance programs, the fun stuff. All right, so what are the different loan categories? We have government insured or guaranteed, conventional, and non-conventional. So government insured loans are loans from private lenders that the government insures, like FHA, VA, USDA, rural development, etc. Conventional is just any loan that's insured by a government-sponsored entity, such as the Federal Housing Administration. We have conforming and non-conforming. And then we have non-conventional, which carry more risk to the lender investor, and it's usually offered when a conventional loan is not obtainable. All right. So we also have fixed rate and adjustable rate loans. Fixed rate is fixed for the life of the loan. It's typically 15, 20, 30 year. And at the end of the term, it's paid off. The pros are the payment doesn't change over time. The con of that is payment remains the same, which could be higher if it was with a different loan or if the rates go down. But you always can refinance. Adjustable is where the initial fixed rate period it's fixed and then the rate adjusts after 2, 3, 5, 7, or 10 years. The pros of this the initial payments may be more affordable, but the cons are the payment is going to increase after a fixed rate period. So in regards to, most of our first time buyers go with a fixed rate loan. The only time you might consider an adjustable rate is if you knew for sure you were only going to live there for a year or two and you're going to sell the place and then move. Maybe you want to consider adjustable rate if it's a lower payment. But for the most part, first time buyers go with the fixed rate, which is just steady. Same period of same mortgage payment for the period of time. And if rates do go down, just know you can always refinance and get that lower rate. There are special homeownership programs offered by the federal, state, and local governments and nonprofits to help make homeownership affordable. Majority of them target low to moderate income families and first-time buyers, and the eligibility may vary across programs and may have some geographic requirements. So we're going to go over a few of them. But I have a question for you. If you make $100,000 and I have no debt, how much can I afford to buy? How much home can I afford to buy? So I actually have this great, of course, you're not going to know the answer to that question, but you can certainly send me what you think in regards to that in the chat box. But I have this chart here that kind of indicates what loan amount you might be able to qualify for. Let's say you make about $100,000, right, per year. So let's go under the right over here where it says 99,599 is my yearly income with no debt. If it's 1, 2, 3, the fourth from the bottom. Okay, so I can afford a house payment of 3,735. the purchase price, let's say 550, and I'm putting a down payment of 19,250. The loan amount's going to be 530,750. Mortgage payment 3,735. But let's see if I add another $500 in debt, my income has to go up to $112,000. Okay, so that's about $13,000 more if I just have $500 of additional debt. With $1,000 of debt, my monthly income is going to need to go to 126,265, almost, $27,000 more with just $1,000 debt. So what this chart shows is, again, the less debt we have, the more we have available for our house payment. And the less income you're going to need to qualify for a loan. All right, let's go into down payment assistance programs. They're typically designed for first-time borrowers, borrowers who need lower down payment options, and borrowers with less than perfect credit. So let's talk about a few of them. So there are community lending programs that offer 3% down, as low as 3%. Wells Fargo offers a down payment program of $10,000 with their Home Access Grant. It does have income and geographic requirements, meaning you have to purchase in a certain census tract. Bank of America provides $7,500 in closing costs and $10,000 in down payment help for a total of $17,500. Again, there's requirements, income and geographic requirements for that. The California Bank and Trust offers $1,500 to $3,000 in down payment. They actually pay the mortgage insurance on those CRA loans and have competitive rates. So pretty much all of the various banks have programs available for first-time buyers. You're going to want to check them out, and also just talk to your housing counselor who knows about all these programs, who can help guide you. Many of them have alternative credit evaluations and flexibility on ratios. Of course, we have the FHA loans and VA mortgages. FHA is the government insured loan program. It's a great first time buyer program and has a 3.5% down payment. VA is for veterans who have served in the military or are currently serving, and it offers no down payment. These programs are, great first-time buyer programs that have more flexible guidelines than conventional loans and no income limits. And so you're going to want to talk to your lender about these different loan programs that are available and kind of compare what works best for you. So there are closing cost assistance, which is different than down payment assistance. It's actually to help you with the closing costs that are to be paid with the loan. So it can go towards closing costs for qualified borrowers, may eliminate upfront closing costs. Usually no repayment is required with these closing cost grants and can be combined with other community lending programs. So maybe you have a closing cost and a down payment assistance program. You could combine those together. All right, so one of the down payment programs that is available is the WISH program. It's offered through the Federal Home Loan Bank of San Francisco. It's for first-time buyers. It is forgiven after 5 years, can be used for down payment and closing costs. You will need to get your first mortgage with a lender that's approved on this wish list. And it provides up to $30,806 for each participating household, matching up to $4 for each dollar contributed. So you contribute $1, they'll contribute up to additional $4, up to $30,800. The application process allocates funds for homeownership based on the program eligibility, and it can be combined with different programs as well. So that's one program. There's also the middle income down payment assistance program that again is for first time buyers, and it's up to $50,000 grant. Buyer has to contribute a minimum of $10,000, and it can be used for down payment and closing costs. And there are income guidelines for this particular program. Again, offered by the Federal Home Loan Bank, San Francisco. There are some additional community assistance programs that are available that can help with down payment or closing costs, usually provided by a nonprofit, federal, state, or local agency, maybe the city. Repayment may be required or it may be forgiven. So you want to know, is it a loan or is it a grant? And will it be forgiven over a period of time? So a couple of them that we have in Orange County and the surrounding areas are the city of Santa Ana has up to $120,000 in down payment assistance that if you purchase in the city of Santa Ana. City of Garden Grove has up to $110,000 in down payment assistance if you purchase in the city of Garden Grove. And those programs, they are silent seconds, so then you will be required to pay them back when you sell the property or refinance or move. There's also $80,000 from the County of Orange for their mortgage assistance program for buying in certain cities that are under the county. Bank partner BMO has a $16,000 grant that's available for down payment assistance. And that is a grant. You don't have to pay that back. City National has a $20,000 grant available that can be used for down payment assistance or closing costs. And the California Association of Realtors also has a $10,000 down payment grant from participating nonprofits. So as you can see, there are many different various programs available. If you're looking for down payment assistance in an area that you're looking to purchase, go to the city, check the county. You can also check the state, see what kind of programs are available, or better yet, talk to your housing counselor and or your lender to learn about the different programs that are available. There's also 100% financing loan programs. This is a community opportunity mortgage offered by First Citizens Bank. It is for first-time buyers only and does provide 100% financing with a $10,000 grant. There is no mortgage insurance required. You do have to meet the income guidelines. And what's required is only $500 from the borrower on 100% loan-to-value loans. The credit guidelines are a minimum 660 credit score for 100% financing, minimum 640 for a 97% loan-to-value ratio. And remember how we were talking about that debt to income ratio? It's a 45% debt to income ratio, and you do need to show 2 months payment reserves in addition to that particular program. They also offer a $30,000 forgivable loan grant that can be used to pay for realtor fees, closing costs, down payment, whatever the borrower needs. So that can't be used with the 100% financing program, but they do have a little bit of a variety of programs. So you want to check all of these opportunities out and talk to your housing counselor and lender to see which one's going to really work the best for you. So question, is there a tool that can help me find some down payment assistance in my area? So as a matter of fact, we work with eHome as well, and they have a down payment tool that you can just Google and say it's down payment resources. Click on that, put in your zip code of where you're looking to purchase and your specifications, and it'll pop up with a bunch of various programs. You can also talk to your counselor, as I said, who kind of knows about all these different programs. We're just giving you a little snippet here. CalHFA, which is the Housing Finance Agency, also has CalPlus, which is a first mortgage loan insured through mortgage insurance and is fully amortized for the 30-year term. which can be combined with the CalHFA ZIP program for down payment assistance and closing costs. There's My Home Assistance, which offers, so that would be a second. It's a deferred payment, simple interest loan, subordinate that can provide up to 3% of the sales price or appraised value of the property, whichever is less. And it's recorded in a second position, but you don't have to pay on it. The CalHFA ZIP program has qualifying ratios, 45% mandatory home warranty insurance, and does require that you take home buyer education. So pretty much all of these programs are going to require this class. So you're one step ahead by completing that class. CalHFA also has a forgivable home equity builder loan, which offers up to 10% the purchase price, and it's forgivable after 5 years. Must attend homebuyer education only for primary property, and there are income guidelines for that program. The Golden State Finance Authority grant provides up to 5% of the loan amount for eligible homebuyers and does not have to be repaid, so it's an actual grant. It's available in all counties throughout California. You don't have to be a first-time buyer for this, and you can even own other properties, but it does require a minimum FICO of 640, and it works with conventional and Freddie Mac loans. The MCC is another program that's available, and it entitles the qualified borrower to take a federal income tax credit. So it's the mortgage credit certificate program, and it offers an income tax credit. What it does is reduce the borrower's federal income taxes and increases your net earnings so it can help you qualify for the initial loan. It provides a federal income tax credit that can be taken year after year. The anticipated tax credit can help you with qualifying for initial mortgage loan. So that's a tax credit that may be able to help you in qualifying for a purchase of a home. And as I mentioned, the VA loan is for veterans or active military members. The VA does not make the loan, they just guarantee the loan. You would be eligible if you served at least 181 days of active service in peacetime, 90 consecutive days in active service during wartime. And if you're in the National Guard, you have to have served 6 years in the National Guard or reserves. You can use it to build, buy, or repair a primary home. You must be a veteran or active military, and you will need to have a certificate of eligibility. The great thing about the VA loan program is that it is no down payment required. So you might want to just check out some of these loan options and see which one's going to work out best for you. You don't have to know what type, but I would encourage you to work with a lender that works with first-time buyers and that understands the programs that are available out there and can offer you options. So how do we find a lender? We take our time to shop, compare. We usually say go to 3, check them out, check your local and state financing programs, read about mortgage lender reviews, try your local bank or credit union. You can also ask friends and family to give you referrals. And we, of course, have a list of lenders that offer down payment assistance programs if you want to start with them. You can always check them out at the NMLS, which is the Nationwide Mortgage Licensing System, to make sure that they're licensed. And never work with anybody who's not licensed, or that, if they promise you too much, and if it sounds too good to be true, then it probably is, right? And that's the reason why we're here. If you have questions about it, feel free to come back to us and ask us questions. That's what we want. We want to be a resource for you as well. So how do you compare the important cost information? You're going to want to look at your loan estimate, which used to be called a good faith estimate. Now we call it a loan estimate. That's going to give you all of the information you need to tell you what is the rate, what are the buy down points, how much do I need to provide for down payment, is there private mortgage insurance that's included in the loan, and that's going to be an extra payment. What are the fees? and what is my monthly payment going to be? So we have an example of a loan estimate. And by looking at this, you can see the loan amount is 162,000. My interest rate is 3.875. My monthly principal and interest is going to be $761.78 a month. Does it include a prepayment penalty? Yes, on this one it does. That means if I pay it off early, I'm going to have to pay up to $3,240 if I pay it off in the first 2 years. You're going to want to know these things. Also, does it include taxes and insurance? Here at the bottom, it says, yes, estimated taxes and insurance is $206 a month. So take a look at this, and the second page. It also, here on the first page, it tells you what my estimated closing costs are going to be, which tells you all of the fees and estimated cash to close that I need to bring to the table is about $16,000. So don't have a copy of the second page, but on the second page, it does show what the fees are. And that's why you want to go shop around and talk to a couple of lenders to see what are they charging you for processing fee, underwriting fee, appraisal fees, and all of that. And compare apples to apples. You're going to want to negotiate for the best deal. Ask if the lender or broker will waive or reduce one or more of the fees or agree to a lower rate or fewer points. Make sure that the lender or broker is not lowering one fee while raising another. Once you're satisfied, ask for a written lock-in to guarantee the rate and the period and the number of points to be paid. If you have issues with your credit, ask how your credit history affects the price of the loan and what you need to do to change that. A lot of times the lenders will tell you. Get your credit counseling before you go shopping and make sure that your credit is in the best tip-top shape. Ask questions if you don't understand. So the loan process, first you're going to do your loan research and education, then you'll do your loan application, then we'll do a pre-approval, then we'll go through processing and underwriting, and then your approval and loan closing. So your research and education is where you're going to sit down with your housing counselor and review your affordability, determine, am I mortgage ready? Am I ready to go? Next, you're going to talk to friends and family and coworkers about their experience and when they purchased a home, maybe get some recommendations of people that they've utilized. Then you'll talk to a mortgage professional without any commitment. You can also go online and do some calculations and kind of see where you're at and how much you can afford. How much would a payment be? If I bought a house for $500,000 and I put, 3% down, what would my mortgage payment look like? Know that Homeownership OC offers personalized one-on-one counseling sessions to review your personal situation and get an estimate of what you can afford. So we want to make sure that you're mortgage ready when you're going into this process, right? Before you go work with the loan officer. You're going to want to find a loan officer that works with first-time buyers and understands the different programs that might be available so they can offer you all of the options. Then you'll apply for the mortgage loan, and it has 10 sections, basically talking about the mortgage, the term of the loan, property information, borrower information, your income and employment, assets, liabilities, details of the transactions, declarations, acknowledgement, and then information for government monitoring purposes. So let's talk about the difference between pre-approval and pre-qualification. So pre-approval is a written commitment from a lender for mortgage funding as long as certain conditions are met. It's where your information is provided to your lender and it's verified. Pre-approvals take more time because it's actually verifying your information and it carries more weight than a pre-qualification letter. So pre-approval, it's going to take some time. They're going to verify everything, your bank statements, employment, everything. Pre-qualification is really just an estimate of how much house you can afford and how much money a lender might be willing to loan you. Your information is not verified. It's fast and easy. It takes about 15 minutes, and you can do this online in a few minutes just to see kind of where you're at. So that's the difference between a pre-qualification and a pre-approval. Um, Pre-approval is what you're going to want to get before you go shopping for a loan. How do you get pre-approved? You'll provide the documents that you'll need to qualify for a loan, which includes your income information, pay stubs, W-2s, tax returns, proof of any undocumented income, bank statements, credit report, etc. Okay, and then all of your information is verified. Then you'll go to loan processing and underwriting. During the processor will complete your loan package by ordering your credit report, ordering your appraisal, and verifying your employment, rent, and bank balances. Then send it over to the underwriter who reviews your loan application and decides whether or not they want to approve the loan. Next, you'll go to loan approval and closing. If approved, the lender will send a commitment letter, which formally states the amount and the terms of the loan that you're qualified for. On closing day, that's when your loan is completed. You're going to get a copy of a closing disclosure, which looks very much like that loan estimate that we talked about a little bit earlier here. But instead of loan estimate, it's going to say closing disclosure. It's going to have all that information of the loan amount, interest rate, monthly payments, amount to close, all of your fees. That document should have everything that you have been promised, that the fees that you were expected to pay. It should be very similar to your loan estimate. So double check it for accuracy. If there's something that's on there that you don't recognize, talk to your lender or talk to your housing counselor. You're going to sign the documents and agree to pay the lender for the money borrowed, and then give the lender right to the property if you fail to repay the loan, the deed of trust. So loan estimate and closing disclosure, two of the most important documents during the home purchase process. Make sure you review them very carefully and make sure they're accurate. We had a client who had sent over their loan estimate and it had $5,000 for a termite inspection. And we were able to look at that fee, and termite inspections are free. The inspection is free. Okay, we weren't doing any termite work. It was a junk fee, basically, that this lender was putting in there. So they went back to their lender, said, you need to take that off, or I'm going with another lender. So it's really important that you understand what the fees are on there. And if something looks strange, or you have a question about something, they should be able to answer it, or for sure your housing counselor can answer that question for you. Oh, here we go. Here's a better copy of the closing disclosure. As I said, looks very similar to the loan estimate, and the numbers should be very similar to what is on the loan estimate. If your loan's not approved, make sure you review the underwriter's decision with your mortgage professional. Some reasons it can get denied is, of course, if you have changes in income, if you took on new debt, maybe you have insufficient assets, or the value of the property is less than the original agreed purchase offer. So, of course, predatory lending, you want to avoid that at all costs. It is predatory or abusive lending combines certain products, practices, and prices that create unfair terms for a borrower. It can include packing, like that $5,000 termite fee, or padding costs and fees, deceptive practices and fraud, high pressure sales tactics. You shouldn't feel pressured to sign things. Don't sign blank documents. Don't sign anything that you don't understand. Watch out for the red flags. And again, if it sounds too good to be true, then it probably is, right? So know that you can take a step back and say, hey, wait a second, I want somebody to review this information. Don't feel pressured to sign things that you don't understand. All right, let's talk about shopping for a home. Any questions on the mortgage process or down payment programs or any of that, feel free to send information, any questions you might have in the chat. So you are going to need a real estate agent or realtor to purchase a home. There are different types of agents. There's the listing agent or the seller's agent that legally represents the seller, usually paid by the seller from the proceeds. And then there's the buyer's agent, which legally represents the buyer, usually is paid by splitting the sales commission with the listing agent or sometimes paid directly by the buyer. So the buyer's agent works for you as the home buyer. Seller's agent is working for the seller. A dual agent would be somebody who legally represents both parties, the seller and buyer, in the same transaction, may be paid by the seller, the buyer, or both, generally paid from the sale and the proceeds of the sale of the property. So be very careful when you're working with a dual agent. I don't really recommend it because you want somebody who's going to be representing you as the buyer. And sometimes when they're representing the seller and the buyer, they may not have your best interests at heart. Now, how do we find an agent? Do your research. You can, of course, ask family, friends, search online, look through local realtor associations. There's Orange County Association of Realtors, San Diego Association of Realtors, IVAR, PWAR. There's lots of realtor associations, and talk to friends and family. You can also check out reviews and records on Zillow, Trulia. Make sure they're licensed with the Department of Real Estate. Check them out and ask if they're members of the National Association of Realtors, and they may have a code of ethics that they do follow. You're going to want to interview at least 3, ask them questions. How long have you been in real estate? Do you do this full time? How many homes did you sell as a buyer's agent last year? On average, how many buyers are you actively working with? We've had clients who've said, my agent never returns my phone call. Like they're so busy, they can't even talk to me. Well, that's not a good agent, right? If they don't have time to talk to you, you might want to find somebody else. On the other hand, how many homes do you generally show your buyers? What experience do you have in selling homes or buying homes in my target areas? And now we also have to ask, how are you getting paid to represent me? Will you ask the seller to pay the buyer agent fees? Because there's been a whole new settlement with the National Association of Realtors, which has changed things. And what it requires is that you have to have a conversation with your agent prior to going out and looking for properties. So you're going to want to, and you're going to have to sign an agreement with them prior to going out and looking at properties. You're going to want to discuss your wants and needs. They're going to do your research on potential homes within your budget. They'll give you access to the homes that interest you. They're going to help you prepare a purchase agreement and negotiate for you for the best price. And they may refer you to other professionals like home inspectors and etc. They have to provide disclosure regarding the real estate agency relationship and the fees that they're going to be charged. Like I said, for the most part, the seller pays the buyer's agent and the seller's agent. That's how it's been done before, but now you're going to discuss this and decide before you go out and view properties, you actually have to sign an agreement. The written agreement's going to apply to both in-person and live virtual home tours. You do not need a written agreement if you're just speaking to an agent at an open house or asking them about their services. But it's a good idea. If you're going to go out and look at properties, then you're going to want to be represented by an agent. So it's a good idea to talk to an agent and have that person available. So you will sign a written buyer's agency agreement with your agent before looking at properties. Before signing this agreement, you should ensure it reflects the terms you've negotiated with your agent and you understand what those services and the value would be provided and how much it's going to be. Written agreements apply to both in-person and live home tours. And as I said, you don't need one for just being at an open house or asking them questions. The seller may agree to offer compensation to your agent. And, if you don't have the funds to pay the agent, um, and you're going to need the seller to, then that person's going to need to negotiate that for you. So just know what you're getting into. I wouldn't think too much about this. It's just you're going to sit down and have a conversation with your realtor prior to purchasing a property before they represent you. So what's your responsibility? Be mortgage ready. Get that pre-approval, be respectful, communicate with your agent. And if you're having problems, you can always find a new one if they're not working out. Have a conversation with them. All right, let's talk about finding the right home. There's lots of different homes out there. There's detached single family homes, duplex, triplex, fourplex, PUDs or planned unit development, townhouse, condominium, manufactured homes. Talk with your agent about the type of home that you're looking for, and what's in your budget. There's also traditional sale, short sale, or foreclosure or REO. Which is real estate owned, which means it's owned by the bank. Right now, we're not seeing a whole lot of foreclosures or real estate owned. Short sale is where the person owes more on the property than they're able to sell the property for. So let's say they owe 500,000, but they're only able to sell it for 400. It's short 100,000, so they have to get approval from their lender to be able to do a short sale. And just know that those take a little bit longer than a traditional sale. Right now, we're not seeing a whole lot of short sales or foreclosures. Majority of it is just a traditional sale. Look at the neighborhoods and decide what factors might be important to you, such as safety, the condition of other homes, the schools, distance to the job. Are there playgrounds and parks, public transportation, shopping nearby, other things that are important? Look at the neighborhoods and know what your needs and wants are in regards to that. And come up with your home buyer wish list. Decide what you need and what you want in a house. And of course, be flexible in that area, right? This may not be your dream home. It may be your starter home. And eventually you will, move up, but maybe it's good for right now. And then in 5, 10 years, you may want to move up. And of course, as we said, check out the neighborhood and decide what's most important to you. There's some tools that are available, neighborhoodscout.com, streetadvisor.com, crime mapping, Megan's Law, homefair.com. Check out these things and make sure, that you're buying into that neighborhood and make sure you like that neighborhood and the neighbors, that are there in that area. Ways for searching for homes. So for the most part, your realtor is going to do this, but you can go on realtor.com, Trulia, Redfin, Zillow offer some options for looking at properties if you just want to get an idea of what's available out there, what the prices are. You can also, drive by, do open houses, be respectful, search online, ask your agent. Your agent's going to do a lot of this work for you, and provide you a list of houses that they are going to show you within your price range. Take pictures, when you're going through houses, write down your, you know, points that you like about the house and any negatives. Make sure you bring your spouse or a family member who maybe can give you an objective view and view it at several times and at different times during the day. Maybe you went during the day, go drive by at night and see what kind of neighborhood it is. Is it quiet, or, maybe there's a bunch of people out in the street, making a bunch of noise. Maybe a train goes by in the middle of the night. Check out the neighborhood and make sure that it's really going to work for you. When you're looking at houses, check for issues that may be like water where it shouldn't be, structural problems, cracks, finish problems, building lines that aren't straight or true, utility system problems, anything that looks out of place, and make a note of that. You're also going to do what's called a home inspection, and we'll talk about that a little bit later, which is going to be a more detailed inspection of the property. All right, so you found the house. What's the next step is going to be making an offer. So your realtor is going to write up the offer, which is a written purchase proposal signed by you and anyone else that's going to be part owner of the property. Before making an offer, ask yourself, have I been pre-approved for a loan? How much fixing does this house require? Can I afford this? Does it meet my needs and wants at the fairest possible price? How long has it been on the market? Sometimes if it's been on the market for a long time, that could be a red flag. So here's a sample of the purchase contract sample. Make sure to include the legal names of the buyers. Make sure everything is spelled correctly. Make sure that the property address is also correct. And it's gonna put right there on the line how much you're agreeing to pay for this property. The number of days it's going to be in escrow after the offer is accepted. And just know that if you are applying for down payment assistance, it might take a little bit longer. So you might want to have a little bit of a longer period than 30 days in case there are delays. By signing, you agree to all the terms of the contract. So you submit the offer. There are 3 possible outcomes. Number 1 is your offer is accepted. Great, you're going to escrow. Let's say the second option is the seller sends a counter offer. That's when the negotiating starts. Or the third, the offer is rejected, and then you would decide whether you want to submit an offer, if a new offer, if it's allowed by the seller. When negotiating, know your limit. Remember that the offer you settle on is the mortgage you will have to pay. You'll have to live with that, right? So, and also, let's say, you offer to pay $450,000 for this property, but the appraisal comes in at $425,000. So you're $25,000 short. Well, that would mean that you would have to come up with that cash of $25,000, right? So just know that there are also what is called contingencies, and we're going to talk about those as well. So let's say they've accepted the offer. Now what? You're going to go into escrow, which is the licensed escrow company or an impartial third party that's going to hold all the funds and disperse them accordingly to make sure all parties are paid and all contingencies are satisfied. All right, so we talked a little bit, I think it's later in the slides about contingencies, so I'll get to that one. So they accepted the offer. Now escrow is the license company that's going to hold all the funds and pay the parties that are going to be paid once all the contingencies are satisfied. They open escrow, and that's the time period between when the offer is accepted and the loan's approved and closed, and the deed is recorded. Then you're in escrow. So within 3 business days, you're going to provide earnest money or a good faith deposit. You're going to, usually it's between 1% and 3% of the home's purchase price. If the sale is successful, the earnest money goes to down payment. Within 7 days, you're going to give pre-approval letter to the seller, verified down payment and closing costs. Within 7 to 17 days, you're going to conduct inspections, review reports and disclosures, request repairs, and remove any contingencies or cancel the sale. So let's talk about contingencies. So on that purchase offer agreement, there's going to be some opportunities to say to have contingencies. where that's events or tasks that must happen before you sell or can complete the purchase. If the contingencies are not fulfilled before the closing, the sale is canceled and you get your deposit back. So typically, contingencies will include loan approval or financing, appraisal, home sale, title, etc. So if your loan doesn't go through, that contingency thing, as long as it's checked, you means you get your money back, your deposit money back. If the appraisal doesn't come in, you get your money back. So we had a client who waived their contingent, had the contingencies on there, and then because it got extended, waived the loan approval contingency and then wasn't able to qualify for the loan. They had to come up with additional money that they didn't have. So they ended up losing $5,000. So I don't encourage you to waive any contingencies that work in your benefit until you know for sure that loans approved, appraisal came in, like all of these things are done. So again, if you have questions, you can talk to your housing counselor or your realtor who can explain those things. But just remember the contingencies are there to protect you. All right, let's talk about home inspections versus appraisal. Home inspection evaluates the structural or mechanical soundness of the property for the buyer. So that's for you, whereas the appraisal determines the property's fair market value for the lender. So why is a home inspection important? It's a professional person looking at the condition of the home. It may change your decision whether or not you want to purchase the home, could save you money on possible problems you didn't see, and reduces the chance of a costly surprise once you buy the home. We highly encourage you to get a home inspection. You can go through, your realtor usually has some recommendations, but make sure they're licensed with the American Society of Home Inspectors or the National Association of Home Inspectors. Typically, a home inspection will cost between $300 to $500. It will need to be paid upfront, but just think of it as a very small investment before you purchase the property. So they're going to go through the property. You can meet them at the property, go with them through the property, or meet them after they're done. And they'll give you a full report of everything they found as they went through the property. Again, it's really highly recommended that you get an inspection. They'll look for any water damage, radon, asbestos, lead paint, underground storage tanks, moisture in the basement, defective roofing or flashing, termites, insect, chimney settling or separation. These are big red flags. We had a client who came back who was able to find a property and they said, "Oh, it's great. Let me send you over the home inspection." And when we looked at their home inspection, it had 25 things. The roof was bad. It had a tree on the roof. The electrical was bad. Had a lot of problems. And they were frustrated because they weren't able to find anything. But that property needed a lot of work. So they ended up not purchasing the property and finding another one because it did have several red flags and lots of issues on it. So the home inspection is for your protection, and we highly encourage you to get the home inspection. HUD wants us to, remind you that it's different than an appraisal. This is for your protection, tells you the property and the condition of the property. You'll also get a title report and title insurance. So the title report is a legal document from a title company. It includes the description of the property and it shows all the liens on the property. You should review it carefully. Title insurance is a policy that's going to be paid during the closing process. And it's insures the lender or a property owner against defects in title and challenges to their interest in the property. So you want to make sure that the property has a clean title report before you're purchasing. You're going to do some closing tasks, which is do a final walkthrough with your agent, verify the condition of the property, You're going to purchase homeowners insurance. You're going to obtain a copy of the closing disclosure. You're going to sign any loan documents and provide any down payment or closing costs to escrow. Escrow then closes when the loan has been funded. And then escrow notifies all parties of the closing and records the title of the property. And that's when you receive your keys. So those are all the closing tasks. All right. Any questions in regards to, I know we kind of zipped through all of that information, but if you have any questions, let's see, somebody asked about how much does an appraisal cost? Typically, it could be anywhere from $400 to $700, depending on the property and the size of the property. And usually you can shop shop the prices on some things. All right, let's talk about homeowners insurance. Or hazard insurance is insurance that covers private homes. It is required by your lender. It protects your asset in the event of structural damage, and it pays to replace personal belongings within the home if they're stolen, and provides liability coverage in case accidents may happen on the property. So what's covered is fire, structural damage, liability, theft, temporary living expenses. You may need additional coverage for earthquakes, expansive soils, flood, hurricanes, landslide, etc. As you're shopping for homeowners insurance, know that there's replacement costs versus actual cash market value. Replacement cost is the amount it would cost to rebuild or repair your home with similar materials, whereas actual cash market value pays you for the loss, but often doesn't pay enough to fully repair or replace the damage. So you want to shop around, get a couple of quotes, at least 3. Make sure the company is licensed, ask questions, and look for discounts if you bundle it with your auto insurance. For individuals who may be living in high-risk areas, high-risk properties, where there's, danger of fire or flood, there's the California Fair Plan, which offers fire insurance to high-risk properties when traditional insurance companies will not. Just know that you do need to have some type of, if you have a mortgage on the home, you're going to need to have some type of insurance. And if your homeowner's insurance lapses, the lender will typically place lender-based insurance on your property. That's very high cost. You don't want to do that. You want to go back and get your own insurance policy and make sure that you're covered. If you have a mortgage on it, you do need to have that coverage. There's also home warranty versus home insurance. So home warranty is optional, but it covers plumbing, electrical, heating, and appliances. If something breaks down, typically it's between $250 and $500 per year, depending on the coverage. Plus, you'll pay for a service call fee, which is usually between $50 and $100. So when you're making a claim, you would call the home warranty company, explain the situation. The company will call an appliance repair provider who fixes appliances. All the repair expenses are covered, but you just pay for the service fee. So it's a good idea to have a home warranty on a home that you purchase, just because you don't know what might go wrong. And some things can be quite expensive, like the air conditioner, refrigerator, etc. So of course your homeowner's insurance is different than a warranty. It's required for the loan, and it's going to cover any kind of damage that happens because of fire, theft, etc. Usually between 300 to 1,000, that depending on many factors. It's definitely been going up, right? So it might be a couple $1,000s. And insurance companies typically only cover the cost of repairs. They don't hire contractors to do the repairs, and they might not cover the total cost, right? So it's important you know what your coverage is and what they cover. All right, and we're getting into the home stretch here. We're gonna do a couple of slides on fair housing. We are all protected by federal fair housing laws. And the protected classes are race, color, national origin, religion, sex, familial status, which is the presence of children under 18 in the home, as well as disability. That includes physical and mental impairment, which substantially limits major life activity like walking, um, etc. That's under the Federal Fair Housing Act. And then here in California, we have California Fair Housing laws, which are a little more expansive, which covers all of those protected classes, plus sexual orientation, gender identity, expression, marital status, medical condition, ancestry, source of income, age, genetic, and arbitrary discrimination. Under the Fair Housing Act and other federal, state, and local laws, they prohibit discrimination in nearly all types of housing transactions and residential settings, including rental housing, purchasing or selling housing, insuring, appraising housing, lending, nursing homes, permanent shelters, other places where people may gather for services. So what is housing discrimination? It includes blocking someone's access to housing, treating a buyer or renter differently because of their protected class status, or denying someone the right to buy, rent a home, even though they can afford the property, just because that person is a member of one of those protected classes. What's prohibited is refusing to sell, lend, rent, or lease housing, represent that a dwelling or house is unavailable for inspection, sale, or rental when it really is available, providing different terms or conditions, privileges, facilities, or services, canceling or terminating a home sale or a loan or credit application or a rental agreement due to their protected class, refusing to provide reasonable accommodations or modifications to a disabled person, making threats, intimidating, harassment, coercion, or making unlawful inquiries. So what are some examples, real estate examples of discrimination? Again, treating members of the protected class differently, like lying or exaggerating sales term, failing to inform borrowers about all the listings, stalling to avoid showing a home, running a discriminatory ad for housing, refusing to negotiate with prospective buyers, steering buyers to certain neighborhoods. For example, a realtor might tell a family, you wouldn't be comfortable in this neighborhood because it's just for professional adults. In that case, it kind of indicates that they don't want kids, right? If they want only professional adults. So that could be a form of real estate discrimination. In mortgage, again, it's be treating someone different because of their protected class status, maybe scrutinizing one loan application more closely than another due to their protected class status, giving an unreasonably low appraisal because of their protected class status. There was a case where an individual was getting a refinance, and the appraiser came in, and the value of the property was very low. So she thought, that's weird that it came in so low. Let me whitewash my house and take out all the pictures of the family. It was an African American family. And when she did that, then the appraisal came in $200,000 more. So she had a fair housing case against the appraiser. Um, so if something sounds out of ordinary, just doesn't seem right, feel free to ask questions. You can ask questions of us or our fair housing partner. Um, Imposing different loan terms or condition, denying loans in certain neighborhoods, also known as redlining, or targeting borrowers based on a protected class, like only for Spanish speakers or Vietnamese speakers. That could be a form of discrimination as well. Some examples of lending discrimination is refusing to provide information regarding all mortgage loan products, steering them to bad or inferior mortgage loan products, imposing different terms or conditions, unnecessarily requiring a cosigner, approving, denying loans based on their protected class, or being more invasive or burdensome with disability income documentation, or perhaps they're denying loans to pregnant women going on maternity leave or requiring them to go back to work in order to qualify for a loan. That could be construed as lending discrimination. The Equal Credit Opportunity Act is a federal law that makes credit discrimination illegal and holds lenders responsible if they break the law. It prohibits lenders from discriminating against for all of those protected classes that we discussed earlier: race, color, religion, national origin, sex, marital status, age, or the fact that the all or part of the applicant's income derives from public assistance, or that they have in good faith exercised any right under the Consumer Credit Protection Act. So ECOA applies to all loans and credit, car loans, credit cards, student loans, etc. From the time you apply to when the account is closed, you're protected. And it also may apply if a person is discouraged from applying for credit as well. Some examples of lending or credit discrimination would be rejecting a credit application based on a consumer's protected characteristics, changing the credit terms or conditions based on the person's protected characteristics, asking if the consumer receives alimony, child support, or separate maintenance payments, asking if they're widowed or divorced, asking if the consumer spouse asking about the consumer spouse, like their spouse's income, when maybe they're just trying to apply on their own, refusing to consider public assistance income in the same way they use other income, or offering credit with a higher credit rate than they applied for, even though they qualify for a lower, based on advertised qualifications. So again, if something just seems out of place, you certainly can ask us for advice, and we can put you in touch with our fair housing partners. Discrimination in regards to foreclosures would be refusing to provide the same forbearance terms to all protected classes, providing less favorable loss mitigation terms to certain protected classes, denying forbearance or loan workouts to certain protected classes, failing to explain available foreclosure prevention policies to certain protected classes, or harsher collection or foreclosure practices based on the race or national origin of residents in those neighborhoods. Individuals who are disabled are also protected. So disability is defined as a physical or mental impairment that substantially limits one or more major life activities like walking, seeing, hearing, etc. Disabled individuals have the right to make reasonable modifications and be granted reasonable accommodations in order to get full use and enjoyment of the housing. So landlords, property managers, real estate brokers, home sellers, mortgage companies, banks can't refuse to deal with you or treat you differently because your income sources is other wages like disability income. For example, a disabled veteran was required to provide information verifying the permanency of her Social Security and VA disability benefits for the next 3 years, but this wasn't a requirement of other individuals who might be refinancing. So again, if you have questions about that, feel free to reach out to us or our Fair Housing partners. We work with the Fair Housing Foundation, and they're happy to answer questions regarding fair housing protections, questions you may have. You can also file a fair housing complaint with them if you feel like you've been discriminated. Their contact information is here, fhfca.org, or you can give them a call at 800-446-FAIR. All right, let's talk about living in your home. Make sure you post emergency contact numbers readily available. Have occasional fire safety inspections. Check out those smoke detectors and the carbon dioxide detectors. Have a fire extinguisher in your home. And if you have a 2-story home, make sure you have an escape plan for your family in case of a disaster. Have a preparedness kit. And install at least one carbon monoxide detector if you do have gas in the home. So It's really important to protect your equity. What is your home equity? Equity is the current market value of the property minus the amount owed on any outstanding mortgage. So let's say the current house value is 700,000, but you only owe 500,000, you'd have $200,000 in equity. Equity is an asset that will help you build your financial future. When borrowing money using your equity, it's called a home equity loan. If you don't pay the loan, the lender will collect the home as collateral. So be very careful when utilizing your home equity. That's how you're building wealth for you and your family and passing it down. So you want to be very careful when utilizing that and not just willy-nilly spending it on, hey, I'm going to buy a new boat and go on a shopping spree. That's not a good use of your equity. You certainly can use it to improve the property, if you need a new roof or a new kitchen or something like that. All right. There's also Energy Star programs and benefits. Energy Star is a program which provides certification to certain buildings and consumer products which meet certain standards of energy efficiency, could help you save some money on your utility bills. You can go to energystar.gov and check it out. There are also new Energy Star homes that are meeting requirements that are applied to new home construction. And it just means that they're better built and may have some energy saving appliances installed, better durability, comfort, etc., and less maintenance cost. There's also discounts that can be used with Energy Star products. So check out your electric and gas companies for discounts for buying Energy Star products or energy efficient thermostats and things like that. You can get discounts from your utility companies. All right, so what are the next steps? If you're already approved for a loan, you're going to want to complete our intake form, do your one-on-one, then you'll get your certificate. You're going to send your certificate to your lender or down payment assistance program. Prove that you took the class. If you're ready to get pre-approved, you can contact a lender, see how much you qualify for. Not sure, you can also contact your housing counselor, right? That can go over that information, meet with them, go over your particular situation. And if you need to improve your credit or start savings and you want help with that, meet with one of our HUD housing counselors. You're going to need to meet with them one-on-one anyhow, but they can help guide you through that process. Want to learn about the different down payments programs that we talked about today, or what you might be able to qualify in certain areas? Talk to your HUD housing counselor. So you finish the class, now you need to complete the intake form. Then you also need to do a one-on-one counseling session with your HUD housing counselor. Once that's completed, then we will send you your certificate and you'll be ready to go. If you have any questions along the way, feel free to reach out to us. We are a resource here that's going to help you. For successful homeownership, avoid risky loans, make your mortgage payments on time, stay current on your property taxes. Remember, I said if your taxes and insurance are going to be responsible for, usually it's included in your mortgage payment in the escrows, right? So it's just paid automatically. Make sure you maintain adequate insurance. Keep your home in good shape. Make sure you keep an emergency fund. We recommend at least 3 months of your monthly payments, whatever your household expenses are going to be for 3 months. Keep that in the bank. It's an emergency savings just in case something happens, you're ready to go. Avoid borrowing against your equity for consumer purchases. And if you do have any kind of trouble in making your mortgage payments, come back to us and we can certainly help you with trying to work things out with your lender. Remember to read all the documents, ask questions if you don't understand, get help from us. We're here to be a resource to you. Know your budget, stick to it. Check out your realtor and make sure they're licensed, dre.ca.gov. Also check out your lender at nmlsconsumeraccess.org. All of them should be registered with them and licensed. And look for down payment programs in the area. you're looking to buy in the city, county you're looking to buy. Shop around, and pretty much all of the lending partners and banks have some type of first-time buyer program or down payment assistance program. So you just need to ask. Use us as a resource because we're happy to be there to help provide whatever resources you need on your journey to homeownership. All right, this is the point where you get to ask questions. If anyone has any questions, feel free to send them to me in the question or the chat box. I'll be happy to answer those questions for you. I want to thank you guys for your great attendance today. You've been awesome. And I'm going to keep the screen up as we go through a couple of questions here. So feel free to send me your questions. As I said, make sure you fill out your intake form, schedule your one-on-one counseling session, then you get your certificate. Go to homeownershipoc.org. Follow us on social media. We're on pretty much all of the social medias, and feel free to contact us if you have questions in the future. All right, couple of questions that came in. How long is the certificate good for? So the certificate is typically good for 1 year, but if you need it extended a little bit longer, come back to us, and because we have all of your information on file, we'll be happy to reissue you a new certificate if it's taking you a little bit longer to find a home and purchase one. We won't make you take the class again. Okay, let's see. Another question. What is the minimum FICO score for some of these programs? So, many programs have, different programs have different FICO score requirements, usually it's dependent on how much you're putting down. But typically, we like to see a minimum FICO score of 620. Even higher if at all possible. But for most of the programs, I'd say 620, 640 is probably a good minimum to be in. If you're in the 700 and 800s, you're in good shape. Okay, and there's probably no need for us to work on your credit. Okay, any other questions? Let's see. Looks like I've got caught up on all of the questions that we have so far. So I want to thank you guys for joining us today. Again, if you have any questions, feel free to reach out to us directly. You can go to our website, homeownershipoc.org, complete the intake form to get started on the process, and then you'll need to meet with the counselor one-on-one to be able to get your certificate. And as I said, we offer rental, credit, home buying, foreclosure prevention, post-purchase. You have any questions about any type of housing, we'll be happy to answer those questions for you. So thanks again for joining us. We appreciate your time today, and have a great day.